The company I will be talking about today is Caltex Australia, which is an Australian company. The company delivers high quality fuel, lubricants, and recently the company is focusing on services and convenience offerings such as retail sites. Currently, one third of all Australia's transport fuel needs are supplied by Caltex. This clearly shows that the company has secured a strong brand name within the industry. Caltex sources majority of refined products from North Asia, Singapore, India, and Middle East. The company has gone through major changes in the recent years. So this includes closure of Kernel Refinery and its conversion to a major import terminal. Also in 2016 was the full year where Caltex conducted trading and shipping capability independently after the departure of Chevron. Caltex made a number of acquisitions, which includes Milemakers Petroleum's retail fuel operation in Victoria and a first overseas acquisition with Gull New Zealand. Caltex also introduced a new brand, the Foodery, into the retail convenience sectors. So looking into the growth of the company, although the company's sales were flat during 2016, there was a substantial growth in jet fuel with volume increasing by 5%, and Caltex Vortex brand premium fuel showed a growth of 2% in retail premium petrol sales and 17% in total premium diesel sales. Now looking into how financial statements has influenced range of stakeholders' decisions. First, looking into Caltex Group management itself. The company's successful closure of Kernel Refinery in 2014 and its successful growth in transport value chain business along the company's ongoing cost efficiency program has significantly improved cash flow in 2015 and 2016, which has allowed the management to repurchase approximately 9 million shares. So secondly, looking at creditors who are one of the main stakeholders in the industry. Again, significant increase in cash flow in 2015 and 2016 allows creditors to identify that the organization has the ability to pay short-term payments based on the company's current liquidity level. And continuous increase in the comprehensive income in the last 2 years also gives assurance to the creditors, which will mean that the company will get more payable period and the creditors will extend the credit timing. So the next one I will be talking about is the shareholders. So based on the net profit, as you can see in the graph, it shows evidently that the company has shown a net profit growth in the last 3 years, and also the return on equity from 2013, although it has dropped in 2014, again 2015 and 2016 you can see a substantial growth. And looking into the net debt to equity ratio, again the company shows strong reduction, which shows that the company has financial fitness, and also it shows that the company has greater financial stability and the company is growing in a stable pace. This will not only influence the shareholders to hold their stock, but also it will influence them to purchase more stocks. So moving to the next part of the presentation, which is focusing on key financial factors that had an impact on company's position and performance. So firstly, looking into inventory. So the company had a total inventory gain of 86 million, which was recorded, and this had an impact on after-tax profit of 610 million. Again, in 2015, there was 135 million of inventory loss, which also had an impact on the profit of 522 million. And looking into the working capital, there was a reduction of 128 million in working capital. This was due to an increase in current tax liability, which was driven by the current year profit, and also due to higher payables, which is driven by rises in crude oil price. So due to share repurchased by Caltex Group, there was a decrease of 18.5 million in issued capital. And again, the operating cost increased by 35 million from 2015 due to additional marketing costs for V8 supercars. But this result was seen in 2016 as the V8 oil sales amount increased. So moving on to the next part of the presentation, here I would be talking about how accounting conventions are followed in measuring key assets and how management judgment also influence on measuring key assets. Firstly, looking into receivables for the year 2016, it was initially recognized at a fair value plus any directly attributable transaction cost and subsequently measured at amortized cost less impairment loss. Due to the short-term nature of these receivables, their carrying value is assumed to approximate their fair value. Maximum exposure to credit risk at the reporting date is the fair value of each class receivables. The next key asset I will be talking about is inventory. Inventory is measured at the lower of cost and net realizable value, and cost is based on first in, first out principle. The amount of any written down or loss of inventory is recognized as an expense in the period it is incurred. Inventory write-downs may be reversed when net realizable value increases subsequently to initial write-down. The reversal is limited to the original write-down amount. And next I will be talking about property, plant and equipment. The cost is measured as cost less accumulated depreciation and impairment losses. The depreciation is property is depreciated using straight line method over their expected useful lives except for freehold land. So these are a few accounting convention methods used by Caltex in the year of 2016. As now you are aware of the nature of Caltex Australia and its assets, liabilities, incomes and expenses, also the accounting standards and convention the organization follows, I will finally conduct a detailed analysis of the financial performance and position of Caltex Australia using relevant ratios and will compare the company trend with its competitor Santos Limited, which has a close market capital as Caltex Australia. So initially I will be talking about profitability ratio. So first I have chosen return on capital employed. So return on capital employed is a financial ratio that measures a company's ability to earn return on all of the capital it employs. Caltex ROCE shows a good trend, and this will encourage investors to purchase more shares from the company. Whereas when you look at Santos Limited on your right side, shows a negative return on capital employed. The reason for this is due to negative earnings before tax and interest. This shows while the company is investing its capital, no income is generated, and this is not a positive sign for the company. Moving to the next profitability ratio, which is gross profit ratio. So this is used to measure how much income is kept in the company as compared to the total revenue. Although Caltex had a higher revenue than Santos Limited, the gross profit margin is lower than Santos Limited. This indicates Caltex is not generating strong sales prices relative to its cost of goods sold compared to Santos Limited. On the other hand, even though Caltex gross profit margin is lower than Santos Limited, as you can see, there is a stable growth, whereas Santos doesn't show a growth pattern in its gross profit margin. And moving to liquidity ratios. So the first one is current ratio, which measures the company's ability to pay back short-term obligation. This is important in determining the company's financial health. Caltex current ratio has ranged from approximately 1.6 to 1.4 in the last 4 years, which indicates the company won't have much trouble paying off its current liabilities when it's due. for the particular time. And Santos Limited shows a much healthier current ratio in the past 2 years. Hence, creditors will be more attracted to lend to Santos Limited than Caltex, as they are aware that they can get their money back in the expected amount and in the expected time. So moving to the next ratio, liquidity ratios, I'll be talking about quick ratio. This is seen as a more rigorous indicator of a company's liquidity than the current ratio, because this doesn't include inventory, as the inventory sometimes take months or even years to liquidate asset to pay short-term bills. So Santos Limited shows a good quick ratio than Caltex, and based on the Caltex quick ratio, which shows below 1 in the past 4 years, indicates that the company cannot pay their current liability and must be looked upon this issue very seriously. And the next one is solvency ratio. So I have taken interest coverage ratio. The formula determines how many times a company can pay its current interest payment with available earnings. Company's ability to pay interest obligation is an aspect of a company's solvency and critical indicator of ongoing concern for any company. Caltex shows a high ratio in 2013 and relatively low ratio in 2014, and in 2015 and 2016 the company shows a very high interest coverage ratio. This indicates the company has a strong financial position, hence it can pay its interest in a timely fashion. Whereas if you see Santos, all 4 years it shows negative figures. So this means the company cannot pay their interest payments, cannot pay their debt. But although the company looks like this, time can pass by, as they can just pass their years just by paying interest and not by paying actual debt. When they have to pay the actual debt, that's when the issue occurs. So the next one is debt to equity ratio, indicates how much debt a company is using to finance its assets relative to the value of equity. This ratio measures a company's financial leverage. As seen on the graph, both Caltex Australia and Santos show relatively similar debt to equity ratio in 2013 and 2014. But in 2015 and 2016, Caltex shows an exceptionally good ratio number, which is below 1. This indicates that the company is not depending a lot of debt to finance the growth of the company, hence low leverage, which means low risk. So moving to the next ratios, that's efficiency ratios. So first one I'll be talking about is inventory turnover ratio. This is an efficient, this indicates how quickly a company uses up its supply of good over a given time frame. Although Caltex shows a gradual growth in inventory turnover ratio, in 2016 the company shows a lower ratio compared to 2015. This is due to sales of normal oil, which was low in 2016. But in general, Caltex shows a good business performance based on the speed the company is able to sell its inventory. Santos Limited also shows a fairly strong inventory turnover ratio over the past 4 years. And moving to the next one, it's the asset turnover ratio. This measures the value of company sales or revenues generated relative to the value of its assets. Santos Limited shows a relatively low asset turnover ratio. This indicates the company is not effectively handling its asset, as the revenue generated using the assets are relatively low. Whereas Caltex shows a relatively high asset turnover ratio, which indicates that the company is using its asset efficiently. Then again, 2015 and 2016 of Caltex shows a comparatively low amount compared to 2014 and 2013. So which means it indicates the company is not generating enough revenue per dollar of asset in the recent 2 years. So that brings to the conclusion of the presentation. Thank you for your time, and I hope you now have a in-depth idea of the company's financial position and how it has generally performed well in the recent years compared to its competitors. Thank you.